As of 10:34 a.m. Eastern Time on November 5th, Palantir Technologies is trading at $185.96 per share, and it is down $4.78 on the day, a drop of 2.51%. Now, for anyone just glancing at their Fidelity mobile app or the Robinhood app, this looks like a bad day. The immediate expectation is that Palantir, the high-flying AI darling, must have just reported terrible news. Maybe they missed earnings or guidance was weak. But the immediate, hard, and absolutely fascinating reality is the exact opposite. This 2.5% drop is happening after Palantir reported one of the most spectacular blowout earnings reports of the entire quarter just last night. The company didn't just meet expectations, it crushed them. And that is the entire story. The stock is bright red on a day when its fundamentals have never looked greener. This $185.96 price is not a reflection of the company's performance. It is the epicenter of a violent, high-stakes philosophical war between a company's narrative and its own stock price. And it is all happening live. For the last 2 years, the expectation for Palantir, the one that has made it a retail army favorite on SoFi investing platforms and a constant what-if for online investing blogs, was that it could be the next great AI company. The hope was that this weird, secretive, government-first company could pivot its spy tech into a commercial gold mine. The belief was that its new artificial intelligence platform, or AIP, was the key. This was the story that had self-investing individuals comparing it to NVIDIA stock or an early Tesla stock. It was the ultimate show-me story. Well, last night, they didn't just show us, they delivered a 63% year-over-year revenue growth report. They posted an adjusted EPS of 21 cents, shattering the 17-cent estimate. But the real number, the one that should have sent this stock to the moon, was its U.S. commercial revenue. That segment, the one everyone was watching, didn't just grow, it exploded, up 121% year over year. They then raised their full-year revenue and profit guidance, smashing consensus again. This was a perfect quarter, and the stock is down 2.5%? Welcome to the brutal reality of Palantir. The reason it's down is the one thing the bulls, the ones on the Robinhood stock trading platforms, don't want to talk about: valuation. The reality is that Palantir's perfection was already priced in. And not just priced in, it was priced in, squared, and leveraged. At yesterday's close, this stock was trading at one of the most extreme valuations on the entire market. We are talking about a P/E ratio over 400. Let's put that in context. Apple stock, the cash-gushing monster, is at 30. Palantir's valuation is in a completely different solar system. This is the disconnect. This is the war. And this is why this stock is a battleground. This 2.5% drop isn't a failure of the company. It's the market's way of saying even 121% growth might not be enough to justify this price. This has set the stage for an incredible fight. On one side, you have the professional bears. Just this week, 13F filings revealed that Michael Burry of the Big Short fame was holding a massive put position against Palantir as of September 30th. He is betting the bubble will pop. He and other traders on sophisticated interactive brokers trading platforms are looking at that 400 P/E ratio. They see a stock up over 170% on the year, and they are saying this is a fantasy. They are betting that the reality of a 400 P/E is unsustainable, no matter how good the story is. And on the other side, you have the company's CEO, Karp, and he is not taking this lightly. In a fiery, almost unbelievable interview this morning, Karp went on television and publicly blasted the short sellers. He called them deranged and self-destructive and said they were betting against America and its warfighters. This is not normal CEO behavior. This is a CEO who knows his stock is not just an investment, it's a movement. He is at war with the short sellers, and he is actively fanning the flames, solidifying his support with the retail investors who believe in his mission. This is a level of drama you simply don't get from a basket of Fidelity mutual funds or Fidelity ETFs. This is a high-stakes, personality-driven conflict. So, let's step back from the drama. What does Palantir do? For a decade, it was a black box. It was the company that built the Gotham platform, the secretive, powerful data sifting tool used by the CIA, the Department of Defense, and other government agencies. This is still a monster business, by the way. Last night's report showed U.S. government revenue grew by 52%. This is the stable, profitable bedrock of the company. This is the part that Fidelity Wealth Management might, at a stretch, find acceptable. But the story, the reason you see it on investing sites, is the commercial side. This is the Foundry platform, and more recently, the AIP. This is Palantir taking its government-grade tools and selling them to corporations. For years, this was the expectation. The Q3 report, with its 121% U.S. commercial growth, is the reality that this pivot is finally and undeniably happening. Companies are lining up to use AI to deploy AI in their own operations, and Palantir is handing them the keys. This brings us to the future, and the path from $185.96 is one of the most binary on the market. This is not a stock for a SoFi robo-advisor or a Schwab Intelligent Portfolios account. This is a high-conviction, high-risk holding for an individual brokerage account. The investment help you need here isn't about the next quarter. It's about which side of this war you believe. The bull case, the one analysts at Wedgebush are pushing with a $230 price target and a $1 trillion market cap thesis, is that this is just the beginning. The bulls see that 121% commercial growth and say, that's the new baseline. They believe AI is becoming the standard operating system for AI, and that Palantir will become a new, unassailable tech monopoly. They look at the 400 PE ratio and say, who cares? They'd say the same thing about Amazon in 2001 or Tesla stock in 2019. They believe the growth is the only metric that matters and that the valuation will catch up. They are buying this dip on their SoFi stocks account, confident that Burry is wrong. The bear case, the one Michael Burry is betting on, is just as simple. This is a bubble. The reality is that the stock is priced for a decade of flawless execution. At $185.96, there is no room for error. A U.S. government shutdown that delays a contract, a new competitor, a single quarter where 121% growth slows to 90%? Any of it could be the pin that pricks this valuation. The bears see the CEO's angry TV appearance not as a sign of strength, but a sign of a promoter, a man trying to hold a fragile narrative together. They believe this stock is a bad investment and that it will inevitably fall back to earth, which is why they are shorting it through their Interactive Brokers account. They'd point out that even after last night's blowout, most of Wall Street, including Goldman Sachs and Morgan Stanley, still have hold or neutral ratings, reflecting this exact valuation anxiety. After seeing a 121% commercial growth number, I want to know what you think. Comment below with one word, valuation or growth. Which one matters more for Palantir right now? In conclusion, this $185.96 and this 2.5% drop are profoundly misleading. The expectation of a stock's reaction to news has been completely inverted. The reality is that Palantir, the company, is executing on all cylinders, transforming from a government contractor into a commercial AI powerhouse. But Palantir, the stock, has become a victim of its own success, a speculative-grade asset with a valuation so high that even a perfect report can't satisfy it. This is a sell the news event, amplified by a famous short seller and a combative CEO. The disconnect is no longer about whether Palantir's tech works. The new disconnect, the one that defines this stock, is whether any company's tech is worth a 400 PE ratio. And how you answer that question will determine if you see this 2.5% drop as a catastrophe or as a buying opportunity. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Be smart with your money.